Hello and welcome to this video in which we're gonna talk about the best 4 investments for passive income. Passive income is a term used in finance to represent money earned from a one-time investment that continues to create income without needing the investor to monitor or actively alter their assets. Passive income is taxable, just like working income, but the IRS treats it differently. Passive losses, for example, can be countered by passive profits. Aside from the tax distinction, many people seek passive income to supplement their cash flow, and the word has come to encompass activities such as working from home or doing side jobs that take little effort, even though they may be taxed as active income. Becoming a limited partner in a partnership is one approach to produce passive income. Ordinary people, on the other hand, can look for different methods to put their money to work for them. The passive investment strategies listed below are worth investigating further. But before started, make sure you're subscribed to the channel and don't forget to turn on the notification bell to miss any new video. Takeaways important. Money generated through doing very little active work or labor is referred to as passive income. Rental real estate, dividend stocks or funds, and limited partnerships are all examples of passive income assets. Passive stock investment, often known as indexing, involves copying a broad market index. Some people think of side jobs or work-at-home jobs as a way to supplement their income. The Internal Revenue Service, IRS, distinguishes between passive and labor income and treats them differently. For tax reasons, passive losses can be used to offset passive gains. 1. Real estate. Despite recent swings, real estate remains a favored alternative for investors seeking long-term profits. Rental properties, in particular, can provide apartment owners with a steady stream of revenue. The investor can easily obtain a house for a 20% down payment and then find trustworthy tenants to keep the cash coming. Real estate fundraising is a good compromise. In both commercial and residential properties, investors can choose between equity and debt investments. Unlike REITs, crowdfunding allows investors to take advantage of the tax benefits of direct ownership, such as the depreciation deduction, without the added responsibility of property ownership. 2. Peer-to-peer lending. Although the peer-to-peer lending, P2P, market, also known as crowdfunding, is just a few years old, it has developed rapidly. It is described as the act of lending money directly to a person or a business entity using online platforms such as Prosper and Lending to link lenders and borrowers. Returns typically range from 7% to 12%, and the investor is required to do very little after first funding the loan. P2P initiatives, on the whole, offer lower entrance barriers than other types of investments. Investors can, for example, support loans with as little as $25. While Title III of the Jumpstart Our Business Startups, Jobs, Act allows accredited and non-accredited investors to participate in crowdfunding, each P2P platform has its own set of restrictions. 3. Stocks that pay dividends. One of the simplest ways for investors to generate passive income is through dividend stocks. When a public company makes a profit, a portion of that profit is siphoned off and distributed to shareholders in the form of dividends. Investors have the option of keeping the money or reinvesting it in more shares. Dividend yields can differ dramatically from one firm to the next, as well as from year to year. If you're unclear which dividend-paying companies to buy, look for those that have a Dividend Aristocrat rating, which signifies the firm has paid out high dividends for at least 25 years. 4. Investing in index funds. Index funds are mutual funds or ETFs that are tied to a specific market index. These passively managed funds try to match the performance of the underlying index they track. As a result, until the index's composition changes, their underlying securities remain unchanged. This correlates to cheaper management costs and lower turnover rates for investors, making them more tax-efficient investments than many others.